PricewaterhouseCoopers. Anyway, today now I'm going to be speaking, narrowing it down to really the risk of credit. I'm with the EXIM Bank, manager trade financing, so the focus is on credit risk. And I would imagine that most banks, when they look at their enterprise-wide risk, credit would come to the fore. And just a brief definition, the credit risk is most simply defined as the potential that a bank, borrower, or counterparty will fail to meet its obligations in according with agreed terms. That's what credit risk is all about. And simply put, this acronym, it has been around for a long time. And for the younger ones going into entrepreneurship, it's simply, if you remember Campari, you will remember these are just basic things to manage risk, whether you're an investor, whether you're a banker, whether you are a venture capitalist, whether you're a shareholder, and even you starting the business. See, the top one, character, is really the background experience of the individuals. That's what we look to. Their integrity, their past performance, their acumen, all of this comes together. Credit risk is not just about, people might think about, sure, it's the ability to repay, but then the credit risk envelops and embodies so many other aspects when you're looking at a proposal. So that is key, the management's capability. The ability to repay, are the skill sets in place? Is the training in place? Do you have the staff set, the skill set? The means, resources to run the business, how computerized are you? Purpose, what are you really borrowing this money for? What do you want it for? How do you plan? How have you planned? As Sushil said, how did you come up with this idea? You know, have you researched it? The amount of money that you want to borrow, can you afford it? Repayment, of course, which is key. Cash flows, as we said, show people present you with the financial statements, the balance sheets, the opening balance sheets and so on, profit and loss statements, but at the end of the day, cash is king. And so, and of course, interest at the bottom, the interest rate. You're not going to walk into, depending on what you're borrowing or your capacity, your capital base, and whether you're a startup or an established business. Maybe you might walk into a commercial bank where you might be paying 15–16%. The credit union may be paying a certain rate. The EXIM Bank, of course, most affordable rates. So you look to interest, you know, the interest rate that you have to pay. And insurance. How you plan to insure? I mean, you have this business here, as Bruce mentioned. Look at that business. Just because of insurance, the business fell flat after fire. So these are some of the things that must be in place. We look to those regardless. The business plan is a key document when you're looking for business funding. As I said, whether you're a new investment, looking for capital, you're applying for a loan. It helps investors and lenders to understand your visions and your goals. You'd be surprised, you have an idea and you can articulate it. Put it down on paper. And then you will realize all the different things that you're missing or you're lacking. Your business plan should explain how the invested or borrowed money will be spent. Set out how this will benefit both the investor and the business and the banker. Potential investors will examine your business to determine whether there's risk or not. It must demonstrate that the principals are committed. The plan should therefore mention how much money you're putting in your business. Bankers need to know that there is something that you have to lose. People do better, and the credit risk is less when investors or borrowers, they have something to lose. Using your assets and guarantees to raise funds. Finding funds. This is a way sometimes from family, friends, and existing investors. And the backing, of course, you have from other banks. The key elements of a business plan. And this is it, because it does help to eliminate risk. Let me go back to it. The business concept, the purpose, details of your key personnel, market research. Can you sell this product? Who? What? Where? Pricing. Mrs. Denton spoke to that, you know. You start out and you have to know what you're doing and where your markets are. A plan is therefore essential. And of course, financial information, because bankers do look to the debt that you have there. There are certain ratios, international best practice ratios, heavily debted, heavily indebted, little bit of equity, prescription for failure, right? Assets tied up in inventory and what? No cash? Definitely. You're looking at maybe some problems there. Financial requirements, and of course, the very last thing, believe it or not, when bankers are looking at credit risk, is collateral information, because the most important thing is the capacity to repay and all the other variables. Collateral really ought to come last, because we don't do collateral lending, okay? That is just a backup in the event. And EXIM Bank is one of the banks that are very flexible, that is very flexible, one of the banks, very flexible in providing those facilities. Your bank would be interested in what you're going to do with the money we set already, how will the business grow, and how will you sustain it. We're not in it just for a one-off. You come in, you want to do this project, but what? Can you sustain it? As Marie said, sometimes you look at one area and you might have to diversify. Her business would have been maybe not sustainable had she not gone outside to look, to develop, to check her competitors, and come back in and change the whole scope of movement or development. What are the loan commitments or debts you have? How do you intend to pay the loan? And of course, I mentioned that before. Your investor, who is dealing with the risk, he's going to ask the same thing. What's your management's track record, your other sources of funding, the detailed forecast of your profits and your cash flow, and of course, the expected returns. This is it. Nobody goes into business without knowing what they get back. The bankers get interest, income. The investors, they earn dividends. The shareholders, dividends. So there must be some kind of way for returns. I was surprised when I heard Mrs. Denton speak about how she would look at her raw material purchases. And I was a little surprised, because right in Jamaica now you hear the call, why aren't we taking local products, But guess what? Our manufacturers are saying it's more expensive to purchase from them, and so we have to import. And I agree with her. What she's saying is that you have to set the stage. To deal with best practices, it's a globalized world, so we have to teach our SMEs to go best practices. So you have to up the ante with government support, which is critical, because right now, electricity, all the other costs add to their problems. But the fact of the matter is that we cannot let go of best practices and globalization. It is a competitive world. So I agree with you. Times of yesteryear, we would say, no, 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 but no, it's about the bottom line and making profits and being sustainable. We have mentioned, this is a very similar thing, which I've said before, time is of the essence. The common weaknesses that we find when we're assessing credit risk. These are the main ones, and those of you who are planning to go into business or you are in business. A weak management team. Again, I'm quoting Mrs. Denton, I listened to her keenly. If somebody on your team doesn't fit, you have to let them go. There's no point in hanging on to this person who you say is a good market, the marketing not going good, production not working, let go. Flawed marketing plan, key. No markets for your product, no cash. Simple, just two things. No markets, no take-up, no cash. Unrealistic forecasts, unrealistic forecasts. The bankers must have assumptions for your cash flow. You must have, and it's not just about assumptions. I'm going to sell 10 barrels of oil, or I'm going to send 40 cases of sauces. Who you're selling it to? What price do you have? Any contracts? What solidifies your cash flows? That has to be there. Incomplete financial history is also something which creates weaknesses in the credit risk assessment. People feel, it is said that SMEs should be allowed to forget about audited financials, forget about financials, just let them come in. It's a cost, there's a fee, but as someone said earlier, I think, you have to factor those costs into your cash flow. Don't talk about just everything else. You have to pay for audited statements, you have to pay for fees, you have to pay customs duty, you have to factor them in. Because at the end of the day, we're looking at sustainability, and there's no point in telling an SME today, don't bother bring me your financials, don't bother with any cash flows. And then tomorrow as they grow, they don't know how to put it together, because that is what the bankers use to assess. That's how you deal with revenues, you know, your costs, and so on. Poor presentation, just a poor presentation. You know, they have ideas, it's all sloppy, it's disjointed, and so the banker says, I'm sorry, we can't assist you. So the advice, seek the help of your business advisor or accountant in compiling your business plan, making a plug for PricewaterhouseCoopers and others. And of course, to revise your business plan as your business grows. The business plan is not static. Nothing is static. And as someone said, if you have a product that is, you're doing something and it's not working, you might have to shift gear a little bit.